Hello everyone, and welcome back to another episode of Simply Wall Street's Market Insights. My name's Michael, and this week we'll be discussing gold and how it's shining while everything else loses its luster. Gold is having a moment, and it's not quietly tiptoeing into the spotlight. While markets have been buckling under the weight of volatility, gold has pulled off something spectacular. A $100 surge in a single day, the first in its history, followed by another $93 jump just hours later. That's a 3.3% rally, pushing the price close to $3,000 an ounce. For a metal that usually grinds instead of gallops, this is massive. Today, we're digging into what's driving this surge, how demand is stacking up, what supply is doing in response, and why this rally might have legs. So, let's get into it. But before we do that though, let's start with the broader backdrop because it's been a week of market madness across the board. Major indexes have posted some of their biggest one-day point moves in history. Percentage-wise, we're not quite at 2020 panic levels, but the swings are getting uncomfortably close, similar to what we saw during the global financial crisis or the early COVID days. Bond yields are on the move too. US Treasuries sold off hard, right alongside equities. The 10-year yield shot up to 4.51%, and the 30-year briefly crossed the 5% line. Liquidity evaporated, and bid-offer spreads hit their widest levels in decades. Some analysts took this as another sign of de-dollarization, a reaction to rising tariffs and Washington's ballooning debt. But there was more going on beneath the surface. Some funds were scrambling for cash to meet margin calls on their positions. Others hit pause entirely, waiting for the dust to settle. A key 10-year bond auction still saw enough demand to calm nerves, albeit temporarily. But the whole episode was a stark reminder that, with over $36 trillion in US debt, it only takes one catalyst to ignite a much bigger fire. When buyers finally hesitate, the Fed could be forced to step in as the buyer of last resort. And to pay for all those bonds? You guessed it, more money printing. Oil markets didn't escape the turbulence either. Prices dropped 22% in the first week of April, hammered by renewed Trump-era tariffs and an unexpected production ramp from OPEC Plus members. Canadian energy execs chalked it up to panic selling, not a breakdown in fundamentals. Demand's holding steady, inventories are healthy, and the pipelines are flowing. But for unhedged producers, margins are suddenly razor thin. Some are trimming capital spending and taking out loans to keep dividends intact. A risky but confident bet that they believe this is just a temporary blip. To ride it out, Canadian firms are leaning into export diversification, targeting Asian markets, and leaning on ESG differentiation to stand out. Analysts still see upside in the more resilient and well-hedged names, especially those with exposure to Asia and limited reliance on spot oil prices. Airlines got hit too. Delta scrapped its full-year guidance after a weak first quarter, blaming global trade uncertainty for softening travel demand. Revenue from premium seating held up, but main cabin sales slipped, and overall capacity growth is now expected to flatline in the second half of the year. The quick shift from optimism to caution underscores how fast changing trade policies can ripple across demand. Some investors are steering clear of airline stocks altogether and are rotating into travel-adjacent names like credit card companies, think Amex, that are still raking in high-margin loyalty revenue. Over in credit markets, the tariff turbulence has put Wall Street on edge. IPOs, merger and acquisition activity, and bond issuance have all slowed to a crawl. Credit spreads are widening, making refinancing harder, especially for junk-rated bonds and private borrowers. That's bad news heading into earnings season, with banks like JP Morgan and Bank of America bracing for weaker profits. The longer the DC noise dominates, the longer capital markets can likely stay frozen. Klarna added to the gloom by pausing its $1 billion US IPO plans. With sentiment shaky and investors skittish, high-growth tech firms are slamming the brakes. Other big names like Plaid, Chime, and eToro are also backing away from the public listings for now. That means tighter valuations and tougher private funding rounds in the near term, with investors favoring cash flow positive names until the clouds clear. And finally, Block Inc., Jack Dorsey's Fintech giant, is doubling down on banking as its Cash App user growth slows. The company is leaning into direct deposits and lending in an increasingly crowded space that includes Venmo, Chime, and Robinhood. Converting peer-to-peer users into full banking customers is the new battlefield. But legacy habits, trust issues, and recent compliance fines aren't exactly helping. Despite a 25% jump in direct deposit activity year over year, investors aren't convinced just yet. The stock is down 32% in 2025 so far, and unless Block turns engagement into profits, the pressure isn't going away. So that's the broader market landscape. But in the middle of all this volatility, gold has been the standout performer. So let's get into the main piece. This rally in gold isn't just about inflation or supply constraints. It's about trust, more specifically, the breakdown of it. Geopolitical tensions are rising. Conflicts in Ukraine and Gaza are dragging on. Tariffs are distorting trade flows, and even US allies are feeling the pressure as economic alliances are being tested. Capital is looking for a safe, neutral place to go. That's where gold comes in. It doesn't rely on political goodwill or monetary stability. It just sits there, solid, neutral, unaligned. Central banks are buying more of it than ever. Since 2008, they've been net buyers. But after the US froze Russia's dollar reserves in 2022, gold buying has gone into overdrive. That move showed the world that USD-denominated assets can be switched off at will. So now, central banks are building insurance policies. In 2024, they added over 1,000 tons to reserves. That's more than a third of annual global supply. Poland led the charge, with Turkey, India, and Middle Eastern nations following close behind. This shift isn't tactical, it's strategic. Gold offers an escape hatch from an increasingly weaponized financial system. Now, inflation has cooled from the highs of 2022, but central banks haven't declared victory. With Trump pushing what many expect to be a spending-heavy fiscal agenda, there's concerns inflation could flare up again. Governments globally are also sitting on massive debt piles. Historically, inflation has been a useful tool to shrink that debt over time. Stimulus spending adds to the fire, and when growth stays low but prices keep rising, you end up with stagflation, which is the perfect scenario for gold to rally. That's why the classic inflation hedge narrative is alive and well. Institutional demand for gold is rising, but this time retail money is following too. In Q1 this year, $7.3 billion flowed into gold ETFs, the most since the early pandemic days of 2020. Hedge fund long positions are growing again, though they're still below the frenzied peaks of 2022 and 2023. Retail interest is picking up, but positioning hasn't hit excessive levels. That combination of rising but not overheated demand creates room for the rally to continue. On the supply side, gold production reached just under 5,000 metric tons last year, a new record and a 1% increase from 2023. High prices are giving miners the incentive to ramp up output, especially from existing projects, but that enthusiasm has limits. Production is expensive to scale, and known reserves are finite. Exploration spending is still cautious, with most of the focus on improving known sites rather than uncovering new ones. Unless gold prices stay elevated long enough to justify a major exploration cycle, supply growth will remain modest. For now, the risk of oversupply seems low. After years of lagging the metal's performance, gold miners are finally delivering. The VanEck Gold Miners ETF is up 42% in the last year, albeit that's just ahead of gold's 40% move. Miners like Harmony Gold are starting to turn higher prices into real profits, with increased production and falling per ounce costs. The challenge is now margin control. Rising energy and labor costs could eat into those gains quickly, so investors need to stay focused on cost discipline and capital allocation. Gold did take a hit after Trump's April 2nd tariff blitz, but that move wasn't unusual. In times of financial stress, even safe haven assets can get sold as traders raise cash to cover losses elsewhere. That's what happened in 2008 as well. Gold dropped during the initial market chaos, but rebounded faster than stocks once central banks opened the liquidity taps. The key takeaway is that gold isn't invincible, but it tends to recover faster and outperform in the aftermath of systemic shocks. Market swings like these can make it easy to lose perspective, but gold's recent performance is a reminder of the value of stability in your portfolio. It's not just about the current price, it's about the underlying value. When volatility ramps up, assets like gold help keep the bigger picture in focus. And tools like Simply Wall Street that help investors connect their narrative to the assets they own can make all the difference. That way, you're less likely to overreact to red numbers on a screen and more likely to stay grounded in long-term thinking. Gold's rally is no accident. It's the result of shifting trust, rising risks, and a search for safety in a world that feels increasingly uncertain. And for plenty of investors, that is a narrative that they still believe is playing out. And that's where we'll wrap up this week's episode. If you found these insights helpful, be sure to follow us on either Spotify or YouTube. While this was just a high-level summary, to read the full article and insights, check out the link in the description. Thank you so much for listening, and until next time, invest well.